If you're a high income earner and you think your tax bracket in retirement is likely to be higher than it is today, then you may be wondering what instruments are available to you for building tax-free wealth. In today's video, I'll be uncovering every tax-free nook and cranny in the IRS tax code so that you can create multiple streams of tax-free income, none of which show up on the IRS's radar, but all of which contribute to you being in the 0% tax bracket in retirement. The first way that high-income earners can create tax-free wealth for retirement is to make sure you have some money in a tax-deferred account like an IRA or 401k. Now that may seem counterintuitive, so let me explain. You will have a standard deduction in retirement, and if every last dime of your retirement savings is in tax-free vehicles, you won't have any income for the standard deduction to offset. You want enough money in tax-deferred retirement accounts where required minimum distributions from those accounts will be offset by your standard deduction. But you also want to keep that balance low enough that those RMDs don't cause Social Security taxation. I'll save you a little bit of math here. If you don't have a pension or some other sort of residual income, the ideal balance in those tax-deferred accounts is about $400,000 if you're married and filing jointly, and about half that amount if you're a single filer. The second way for high-income earners to build tax-free wealth in retirement is by contributing to your Roth 401k or Roth 403b. Remember, there are no income limitations for these types of qualified retirement plans. You will be contributing after-tax dollars, but those dollars can be distributed tax-free in retirement when your tax rate could be much higher than it is today. If you're younger than 50, you can contribute $23,500 per year, and if you're over age 50, you can add another $7,000 on top of that for a total of $30,500. By the way, you can earmark your company match towards the Roth portion of your 401k as well. Just keep in mind that you will receive a 1099-R for the match, and you will have to pay tax on that amount. The third way to build tax-free wealth for retirement is by way of a backdoor Roth. This would be an appropriate alternative if you are making more than $240,000 of modified adjusted gross income if you're married filing jointly, and $161,000 if you're a single filer. Here's how it works. You can contribute $7,000 if you're younger than 50 and $8,000 if you're older than 50 to a non-deductible IRA. That means that you're contributing after-tax dollars. And right after making those contributions, you can then execute a Roth conversion. Because you already paid taxes on those contributions, you would owe no tax on the conversion itself. So this ends up being a roundabout way to get money into the Roth IRA if you exceed those modified adjusted gross income limits. Keep in mind that if you have money in other IRAs, you will be faced with the pro rata rule, which could cause you to pay tax on that Roth conversion. As a general rule, the backdoor Roth works best if you don't have a lot of money in other IRAs when you make the conversion. It's okay if you have plenty of money in your 401k, just not IRAs. Once you've exhausted the first three tax-free alternatives, the question is, what comes next? If you subscribe to the mainstream financial guru approach, you may think the next best alternative is a taxable brokerage account. This is, of course, not the best place to accumulate retirement dollars, particularly if you believe that tax rates are likely to go up over time. Any short-term capital gains will be taxed at ordinary income tax rates along the way, and any long-term capital gains will be taxed at long-term capital gains rates when you sell your investments. If you're contributing after-tax dollars, why not take advantage of what CPA and retirement expert Ed Slott calls the single greatest tax benefit in the IRS tax code? Cash value life insurance. And the cash value life insurance alternative that grows safely and productively and is most likely to outstrip your taxable brokerage account over time is indexed universal life. Historically, IULs from solid carriers have been able to net 6% net of fees over the life of the program without taking any more stock market risk than what you're accustomed to taking in your savings account. Let's compare the IUL versus a taxable brokerage account and see in what scenarios the IUL comes out ahead. Let's say the money growing in your taxable brokerage account is experiencing 100% short-term capital gains and is growing at 9% per year. That means that whatever growth you experience is going to get piled right on top of all your other ordinary income and be taxed at your highest marginal tax bracket. So the question becomes, if you could consistently get a tax-free 6% net of fees in your IUL, what rate of return would you have to get in your taxable brokerage account to come out ahead? To determine this, we simply take that 6% net rate of return and divide it by 1 minus your marginal tax bracket. So let's go through some tax brackets and see how this shakes out. If you're in the 22% tax bracket, we divide 6 by 1 minus 0.22, which gives us a 7.69% return. In other words, you'd only have to get 7.69% in your taxable brokerage account to outperform the IUL. In this comparison, we believe the stock market can get us 9% net of fees over time, in which case the taxable brokerage account might be the better recommendation. All right, let's try the 24% tax bracket. We divide 6% by 1 minus 0.24, which gives us a 7.89% rate of return. In other words, you'd only have to get 7.89% return in your taxable brokerage account to beat the IUL. A 9% stock market return would beat the IUL in that scenario. All right, now let's try the 32% tax bracket. That gets us to 8.82%, nearly a wash. Next, we'll try the 35% tax bracket. That gets us to 9.23%. If we believe the stock market will deliver 9% over time, then the IUL is the better alternative. Lastly, we try the 37% tax bracket. That gets us a gravity-defying 9.52%. Again, if we only believe the stock market can net us 9% over time, then the IUL would be the better alternative here. Can you start to see how the higher your tax bracket, the more it makes sense to reposition surplus savings from your taxable account to indexed universal life? Now, not only does the math make sense in those higher tax brackets, but the IUL has flexibilities that make it an appealing place to build tax-free wealth. First, there are no contribution limits. So if you needed to sock, say, $50,000 or even $100,000 into your IUL per year, you can do it. Next, there are no income limitations. So even if you make far in excess of the modified adjusted gross income limitations of the Roth IRA at $240,000, you could still contribute to the IUL. Next, we have to remember that the IUL is delivering safe and productive growth. In other words, you're getting competitive rates of return without taking any more market risk than what you're accustomed to taking in your savings account. When you incorporate this type of asset into your portfolio, you increase your returns, you lower your risk, lower the standard deviation of your entire portfolio, and experience a better outcome over time. In short, if you're in a higher income tax bracket and you think your tax rate in retirement will go even higher, then there isn't any one solution when it comes to building tax-free wealth. The best approach involves incorporating multiple streams of tax-free income, none of which show up on the IRS's radar, but all of which contribute to you being in the 0% tax bracket. You want to take advantage of every nook and cranny in the IRS's tax code in an effort to shield yourself from a precipitous rise in tax rates down the road. Folks, my upcoming book, The Guru Gap, How America's Financial Gurus Are Leading You Astray and How to Get Back on Track, is now available for pre-order on Amazon. Take the opportunity to order your copy today. By the way, in the next 10 years, I'm looking to put 1 million Americans on the road to the 0% tax bracket. If you would like some help implementing a balanced, comprehensive approach to tax-free retirement that shields you from the impact of higher taxes, head on over to davemcknight.com and click on the Connect with an Advisor button. I'm happy to refer you to an advisor in the Power Zero Network that has been trained, vetted, and qualified personally by me. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head over to powerzero.com and opt into my free video series. And if you have any comments or questions, feel free to drop them into the comment section below. I'll respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.